Good day, everybody. This is Jim Kinney reporting for the OptionProfessor.com weekly market update for May the 10th in 2019. As always, I do remind you that past performance is not necessarily indicative of future results, and there is substantial risk of loss in short term and option trading. And so you should consult your clearing firm, your broker, and your good common sense before you entertain any idea in any of these markets. By way of introduction, if you're new to the broadcast, I'm Jim Kinney. I'm a graduate of Boston College, and I have been in the investment arena here for decades. Much of my time has been spent doing seminars, both live and online, for option trading, going over the uses and the risks of options for both limited risk speculation, cash flow purposes, as well as hedging, using them for a protective device against positions. Okay, so I am going to give you a quick review because obviously this has been a very big week and I want to not waste a lot of time here. So let's get right to it. As far as the stock market is concerned, obviously this week has been one about the tariffs. But if you listen to my broadcast for any length of time, I'll give you a quick review. In the fourth quarter, we dumped down to 2350 on the S&P, and I suggested that it's possible to go right back to the 200-day moving average, especially when the Fed went on pause. We went right back to 2750 area, and we went through it. My next target after that was the all-time high of 2740, 2750. Excuse me, 2940, 2950. And of course, we went up into that area. When we got up into that area, I did mention that there was a blow off potential up above 3000 to 3100, but I did say that the put call ratio was at 85%, and the bullishness seemed to be very excessive, and the VIX had gone down to 11 or 12. And so, if obviously the news changed at all, there'd be some vulnerability because the market was very much leaning to the upside. And of course, the tariff tweet from last Sunday obviously was the match that lit the fuse. But again, the setup was for a correction any way you slice it, simply because of the overbought nature. Now, with regards to what about right now? Well, we're having the pullback that I pretty much expected, and there is a range that the market, if it is going to remain strong, should be able to hold up to. And today you're getting whacked very hard again. You can see right now, as I'm speaking, it's minus 344 and minus 142 on the NASDAQ right in front of you there. So what's the range that I'm looking at? Well, you got the 200-day average coming in, 2775. I would think that's not a bad place to call an area where it could stop and then bounce out of. And then, of course, lower than that, you got about 2680 to 2700. So there you got two lines in the sand that you'd like to see it hold. But I'll show you a few things that I'm looking at that don't look that great. But, again, the economy is not bad. People are working. GDP is growing. So, the setup for a recession or a big drop right now doesn't seem to be in line unless there's an event. Again, an event could very easily be, China retaliates with tariffs on our semiconductors, which we're very dependent upon them buying. And in fact, if there's going to be a big thing on that, that's going to be damaging to the semi area. And of course, the debt. Sovereign debt, meaning you loan people money in Germany or Japan, you don't even get your principal back after 10 years. That's pretty weird, right? So bottom line, there's about 10, 11 trillion dollars in that stuff. And obviously it probably could not stand a redemption run. Also, the liquidity in corporate bonds showed their ugly face in the quarter number 4 last year, because when they blew out the candles at the party and everyone wanted out a high yield, the bids just weren't there and the thing fell under its own weight. There's risk of that right now as well. So again, it's never easy. It's never totally clear. But as I see it, as long as we can hold this 27.75, 28.25 region, I think it could be a situation where we're just seeing a pullback and that things would get better. If the President Trump thinks he's going to bully the Chinese, as he may have tried to bully some homeowners association who owned a bunch of condos, I think that tactic is very bad. And this is my opinion. When you don't respect your opponent, you tend to lose the game. So I come from a sports background, and I've seen a lot of teams go on a field overconfident, thinking they held all the cards, and they went home with their tail between their legs. So a little bit more respect for the opponent, and get what you want, but do it in a respectful way. I think that could be something that could be done throughout many things that are going on right now, showing a little respect for the other side while you try to get your result. At any rate, where are we? We're on the defensive, and let me show you some of the things that I'm looking at and give you what they're telling me. Okay, I always try to keep an eye on the transports, right? And the transports today are showing me that they are down 227. That's not very good. You see how it's breaking underneath 10.5? That's not very good. We don't want it staying underneath 10.5. If this only down here for a day or two and then right back on the bicycle, no problem. But if it starts deteriorating and staying down here, I think the trend that everybody has so much confidence in may be in jeopardy. So again, the transports are down at 10,399. More importantly, I will show you in a second here on the detailed quote. Just give me a moment here so it comes up. It'll show you the 50-day and the 200-day moving average. And you'll see the 50-day is at 10,567 and the 200-day is at 10,528. Inverted to the upside is not bad, but trading at 10,399 underneath both of them, again, is not good. And if it stays under there, those averages could turn to the downside. So again, if this is only down here temporarily and we get back on the bicycle next week, then I think you're okay. If this 2775 S&P 2825 holds, I think you're okay. If not, you got to reassess. And again, the other thing I look at is the Russell. They've been good to me as far as giving an idea on direction. By the way, the transports and the Russell did not make all-time highs. Now here we got the Russell down at 1549, and you can see it's holding on to that 1550 number. We break under 1550, that's not good. So again, obviously we're being tested here. Obviously the news on the tariffs is being negative. I think President Trump is believing that he has house money to gamble here. But if we go 5 or 10% lower than this, that house money gambled that he's gambling will be gone. So the bottom line is that, again, there is some problems in the deal with changing laws in China, and that's not an easy racket. And again, that's one of the big problems that may not be surmountable. With regards to the Russell, again, on the defensive, and I think their moving averages come in right around this 1550 as well. So again, this 1550 on the Russell, this 10,500 on the transports, I think are pretty key areas. Let's turn to the S&P itself and see what's going on there. Again, there's the graph on it, and you can see it's rolled over. Again, it's trying to hold this 2825 area that I mentioned. So far, it's done it. If that breaks, 2775 is the number. And if that breaks, then you got to get your pencils out and figure out where the next level is. But the bottom line is that the market is on a defensive. Tom, Dick, Harry, and everybody else got long stocks. And obviously, with this news, there's no buyers up here. So the guys who are on the other side of the trade, meaning when everyone's selling, somebody's got to be buying. And the guys that are buying don't have to put up a good bid price because they see the volume is huge trying to come out. So obviously they're dropping the bid down to where they think the volume may dry up. And that's somewhere between 27.75 and 28.25, which we hit today. Okay, so keep an eye on that. Let's look at the VIX. Now, again, when we're up at the high points, I'll get to that in a second again, I did suggest that you investigate certain things, and that's what you've got to do when it's time to do it. Okay? All right, so anyway, 1950 is where the VIX is. It looks like a spike up high there that might not get taken out. That's a good sign if you're bullish. But if it gets taken out, look what happens when we get above 25. You can get some real good abyss selling. Again, you get above 25 on the VIX and you don't know what's going to happen. I remember the VIX hitting 50 at one point after it got above 25. So the risk when it gets above 25, in my view, is on high alert. And of course, the short volatility people have to buy back their positions when it goes high on the VIX because obviously the puts that they've sold have expanded dramatically. Leon Cooperman was on TV yesterday, and although this is not a recommendation or this is not a suggestion of any type, I'm just reporting what he said. He said that he did sell the September 2250 puts for $15, which means on the S&P, he is looking for the S&P to not get underneath 2235. That's 2250 minus his 15. Between now and the September expiration that he sold. So again, when the market was up, my suggestion was for you to investigate covered call writing up here, right? Covered call writing, and then collar strategies where you take the call premium and buy a put. And then if you did that, The call pays for your put, and then basically when it comes down, you've got insurance, put, and you have something offsetting that exposure. That's what I suggested you investigate at the highs. Now, also, I suggested even buying a married put. For gosh sake, if you've had a rally from here to here, you must have some gain in there. Take a little bit of your gain and buy a put, and then you have something to offset the risk that's coming down on you right now. Okay, so that's the strategy when you think that the market might be at an apex, right? At least temporarily, because you know that the call premiums are probably pretty fat on many things when the market's up high, right? So, covered call writing, collar strategy, married puts. Don't understand how they work? Need more information? Would like somebody to talk to you? Send me an email. optionprofessor@gmail.com. optionprofessor@gmail.com. Also, if you have friends or associates who, obviously might be in the soup right now, and they want to hear another voice of reason, hopefully, and they could come to the webinar or they could listen to the session here each week by simply going to optionprofessor.com and getting the link. Okay, so again, if you don't think it's going to break this 2775, 2825, and obviously you think it's not going to go down under 2300, that's where that idea of selling the 2250 put would come from. Now, that strategy is not suitable for everybody, and it's not right for everybody. But again, when you do sell a put while the market is down and the VIX is elevated, you can get a reasonably strong premium. Now, if the market rises from here and the time runs out, that would be an option that would go to zero. You keep the premium. If the market goes down but sideways here and the time runs out, again, that would be something that would let the premium decline. The risk is, of course, that it drops down dramatically. The put expands dramatically. You have to buy it back at a big loss. And of course, that's the risk when you write the puts, that you have to buy back the premium a lot higher than you sold it. And then, of course, you have to take a loss. But again, when you look at this graph and you look at the number 2250, which is not even on the graph, it's underneath 2300. That's a pretty substantially far out of the money put. Again, September is a decent amount of time, though, between now and then. At any rate, you look at what you're looking at, you have your scenario, you look at your strategies, and you come up one you can sleep with. If you're selling naked or uncovered options, obviously that's at the high of the risk spectrum because there's nothing covering it and your risk is not limited. Okay, so again, some people do credit spreads where they sell one put and then underneath they buy a put to put a little bit of a bracket on what their risk is. Again, there's a lot of different ways to skin the cat. If you have questions, simply give me a ring. Give me an email, optionprofessor@gmail.com. Okay, one thing that I did hear, the Nikkei has not made a new high during this advance, and the Kospi over in Korea is also indicating, a little bit of sideways action. Now, there is a sector called semiconductors, and supposedly inventories are getting big. And supposedly prices are dropping, and there could be some significant exposure. And of course, if we have a trade war and China slaps tariffs on our semiconductors, right, then obviously that could have a big effect on this industry, which may be already slowing with high inventory and tough margins. So you can see this is something that I would keep an eye on if you thought that there was vulnerability on the downside. It's already gone down from 120 to 108, and today it's down 2% again. Let's look at the moving averages and if it gives us any indication of what the prices are doing. Okay, there you go. The moving average on the 50-day, come on over here, is 108. And the 200-day is 100. So again, it's not unheard of that we may go down to that area. And when you're up at 120, again, this is one of my things as well. When you're up at 120, what's the high been here? Let's just take a look at what the high has been in the last 52 weeks. It's been at 120. So you take 120 minus your 200-day average, and what do you get? You get $20 divided into 100. That means you're 20% above the 200-day moving average. Okay, and that, in my view, is when the market's vulnerable to having a rollover. Again, we saw this in Boeing. when it hit 445 and the moving average was 355. We saw it in Amazon when it hit 2050 and the moving average was 1550. We might be seeing it here in Chipotle. Keep an eye on Chipotle. Chipotle is 696, but again, the 200-day moving average on this thing is 528, and that looks like a little bit of a high point. Now, if we can take out 650, I think the likelihood will increase significantly that we could come into this gap, because this gap is exactly where the 200-day moving average is. Now, again, it would be a risk if it goes up to 750. Obviously, you're wrong, and you'd lose money by having a negative bet. But if it goes up to 750 or 800, it's certainly not going to be less overbought, right? So again, if you can have a limited risk situation here, and then if it works, great. But if it doesn't, again, if it goes to 800, you could revisit it and see what you think. But again, this is a company that fits the profile of what I look for the standpoint of huge run, sideways activity a little bit, and then, of course, the moving average being 20, 30, 40% above, the prices being 20, 30, 40% above the 200-day moving average. Because in my view, my opinion, that it sometimes reverts back to the mean. Okay? Now, there are, let's go over some different sectors here so you can see what's going on in the world. The financials. Okay? XLF. Okay, was doing very good. Now it's on the defensive. Clearly, you've got a lot of resistance here in the 28 area, and it did not take out the 29 area, which was the 52-week high. So it went up to the 28, and now it's come back down. There's a gap there that it might be trying to fill. And so if it can stay above 26, that would not be a negative. And again, people have been touting the banks for so long, I'm tired of hearing it. But the bottom line is some people do think the banks may do better going forward. But right now, again, it hasn't done much. There's the chart for the last year or so. And you can see, 22 when things got bad in December, 29 when things are great. Now it's at 27. So thankfully, they do pay a dividend, a lot of the banking stocks, and that's not bad. The energy market is definitely on the defensive right now. It ran up to 66, 67, and now the energy, I think it's at 60, 61. Again, this just like this, it had, if you look at it here, it looks a little bit, this is on the energy now. It looked like it was doing well, right? And then it came way down in December, and then it looked like it was trying to do a head and shoulders bottom here, right? But the neckline's right around 70, and it couldn't get above the neckline. It looks like it's giving up. So if it can get back above 65 and then above 70, then it makes more sense to get bullish on this thing. But right now, it's definitely on the defensive. On TV, one gentleman was mentioning a stock in the area of energy that they believed had some pretty good value. And that was Mr. Cooperman again. Now, again, he'd be the first one to tell you, don't go buy anything just because he looked at it or just because I say something. I'm not making specific recommendations to people I've never met. Again, so I'm just talking my opinion here and my view. But one thing here that he did mention was a company called WPX. Let's see if it makes any sense technically right now. Right now it's at 12.31. It used to be $20, so obviously it's come down just like oil. The Anadarko thing with Oxy went through, and so again, let's take a look at the moving average here and see where it might make sense for this thing at all. Let's take a look and see if they're telling us anything as far as the trend is concerned. Okay, you got 1291. Let's get back here. 1291 is the 50-day. And 1483.86. So technically, it looks very bad as far as I'm concerned, as far as the trend is concerned. If you're a value guy, you might look at this thing. But me personally, I don't like the way the traffic is going on that particular stock. I just was looking at it because it was mentioned. Okay, so what else is going on? What about healthcare? United Healthcare, big whack. And let's see what's going on now. I told people about this a couple of sessions ago. When we went down to 208, I showed you that the volume is enormous. See the volume? And you got a low price. And the moving averages are above the market. So again, the likelihood you're going to come back towards the moving averages made a lot of sense. And that's what's happened. But this market clearly is still in a downtrend. because of all the talk about how they're going to change the healthcare system. They may not change it at all, but if talk becomes fact, then I think we come back down. If talk becomes talk, then this 208 could be the low for quite a while, because that's a high volume sell off. Okay. That means what? That means Tom, Dick, Harry, and everybody else is getting out, and there's somebody on the other side of the trade who says, look at this volume coming in. Let's drop the bid to 210, take it all in, let the volume go up to 30 million shares, which is like how much more than normal. We'll take it all in at 210. The volume will be done, and then look how the volume dries up. Well, when the volume dries up, it bounces right back up. Use a common sense. If there's no more sellers, you got short sellers who are going to want to buy. You got specs who want to buy, value guys who want to buy. So now the guy does the direct opposite. You guys all want to buy? I'll lift the offer to 240, and you can buy all you want here at 240. Okay. Don't forget, there has to be a buyer for every seller. And if there's no buyers or no sellers on the other side, they're going to move that price as far as they can, take in the volume under the expectation that when the volume dries up, it'll go the other way. It's not a bad bet, and it works a lot. Okay. That's the healthcare situation. The metals seem to be having some trouble because, for whatever reason, they're thinking that the inflation's not coming back. I've never been around more of a unanimous opinion that there is no inflation, there'll be no inflation. This time it's different, and we've got a situation here where it's just different this time. I can't tell you, after decades and decades of being in this thing, how many times I've heard that. And that's when my antenna goes up going, I don't know that they're right. So again, you're looking at the gold shares, right? GLD going from up here down to here, and now it's consolidating. Let's look at GDX, which is the gold miners. Now, again, if you listen to the broadcast, I did mention to you that it looked like it had its short-term run when it hit about 23.24, and that the support was around 20. So basically, right around 23.24, we petered out. That's where you would have either sold calls, did collars, buyed Mary puts. Now you're down here, and you want to see if it can hold this 20 area. If you can hold this 20 area and get back above 21, then I think we're back on the bicycle. Hey, listen, everybody's working. What do you call it? The budget deficits are going through the roof, and in those two things alone, and the GDP, for whatever the number they're using, is very strong. This doesn't seem like a situation where there is no inflation. I know when I go out to buy things at the store for food, I know when I go to the gas station, things are more expensive than they were. So I don't know what they're doing, gauging inflation on widgets or something. But, housing prices certainly are very high, and they've made a very big move in the last 5 years. So the bottom line is that they say there's no inflation, but if they start admitting that there's some inflation at some point, then of course the gold could get back on the bicycle. And another thing that would help the gold would be the US dollar dropping. And let's see what that looks like. Oh, too many Y's. Too many Y's. Okay, there you go. On the dollar index, it's down a little bit today, but it's still at that elevated stage, right? It went up above 98, right? And, people started getting negative on the dollar, and then bam, they brought it back up. Now they brought it up to a new high. Okay, so everybody wants to buy the dollar. Somebody offered it up here above the high and got everybody going. What's the volume look like if we have it? I don't know. No, they don't have it here. Okay, so the bottom line is if we break under 97, that would be telling us that the dollar may be dropping. If we get under 96, that would be something that tells you the dollar may be dropping. And under 95, I would consider the dollar possibly in a downtrend. So keep an eye on 97, 96, 95. And if they can roll this thing over, that would be a game changer for gold, I think. The other thing out there is that the Chinese may be in the position where they may drop their currency. And if they drop their currency, that's going to change a lot of things, both in stocks and commodities. Okay, so keep an eye on the US dollar and the yuan, because that could be the little game they play. Slapping tariffs on the semiconductors, and also looking at a situation of, what do you call it, changing the currency. One last thing here I want to go over is in the agricultural sector. These farmers are getting hammered, right? Hammered, right? So what has President Trump been doing? He wants those votes. I mean, who are you kidding? He wants those votes. So he's going to get something going for these people. people, but it's not working. Today he makes this big announcement that the government will buy the soybeans and the grain from people, right? That's what he said today on the Twitter or whatever he communicates with. And so what happened here? Well, we just went down to all-time lows here recently at 806. Okay, these farmers are getting nabbed, right? And now you're looking at what? It's right down here at $8. So again, is there a potential value here? Yes. Why? Because if he does strike a deal and the Chinese say, oh, hey, listen, we got to eat, we'll buy that. Sure. Okay. Well, then you could get this thing turning around. But look at this thing. This thing has been nailed. And I'll give you a little bigger viewpoint here because I think this is kind of a major thing. Chipotle is a very overbought condition in the stock market that I'm monitoring. And the soybeans are very oversold, which is what I'm monitoring on the other side of this thing. So again, take a look here and you'll see in the last, 10 years? Let's see. This goes back to 2016. Okay, so look, it used to be up higher and higher and higher. I don't know why this only gave me this. Let me see. Yeah, it's all data. Okay, it doesn't go back that far. But this stuff used to be $15 bushel, okay, years ago. Now this thing, look, but the volume, okay, this might be telling us that it's getting close because the volume is going through the roof here and the prices are way down. So these people are not saying any deal is imminent with the Chinese, right? But they're also getting out in a little bit of a panic, right? And people get out or in a panic sometimes is not the genius thing to do. So monitor this agricultural product, I think, and look to see if there could be some turn in here at some point because they are very, very discounted in price. Doesn't mean they're going to go up, but it certainly means they're not going to go to zero and they're at 8. So the bottom line is start looking around there because if a deal is done, he wants those farmer votes, and I haven't heard him make one speech where he isn't saying that he's going to take this is going to be great for the farmer, great for the farmer. So be aware of that and keep an eye on that as well. Okay, I'm going to quickly go over to Asia here and give you a couple of stocks. Let's look at BABA. This will give you a little idea of what the Chinese stock market is up to, because BABA was their poster child of good fortune, and you can see it broke a little bit. But again, when it was down around the 130, this company is a monster. It's a monster. So the bottom, big company, bottom line, and it had a very big run, right? Then it pulls back here, right? And so this number here in the 130 area, I think that's a very big number to defend against. Now it may come back a little further, maybe 160 or something like that. But if they do resolve this situation, this is a company that should be, in good shape. But I tell you right now, it's hard to get hugely bullish when they can't take out their former highs. And that's the case in the Russell, and that's the case in the transports. If you can't take out the former highs and you start giving it up, and some of the dominoes fall the wrong way, again, that's why I suggest people investigate how to collar your positions, how to do married puts on the position, and how to at least do a short term or do covered call writing. Covered call gives you limited downside protection, but limited better than none, and does create cash flow. Now, there is a risk if it goes up. You've got to investigate the strategy. Okay. And again, if you're not sure how to investigate it or you have questions, you simply email me, optionprofessor@gmail.com. Now, again, we covered a lot of different sectors here and a lot of different areas that are going on right now. Again, going back to, let's go back to one other sector that looks like it could be vulnerable too. And that's the utility sector. Many of you might be in that. And then I'm going to go over interest rates real quick to wrap it up, because interest rates obviously are a big thing. This is the Vanguard Utility Index, which I'm trying to get up for you here. Okay, and we'll get that in a second. Okay, but while we're waiting for this chart to come up on the Vanguard Utilities, again, I'm looking at the 10-year note. Okay, the 10-year note is trading between 240 and 260. Okay, if they break it down, to under 240, that's not very good, I don't think, for the economy. Because if these rates go down because there is no strength in the economy and consumer spending is going to drop, it's going to be a problem. Okay, but if it breaks down under 240, 235, 225 is in the cards. If we get above 260, there's a lot of people who believe with the growth in the economy, with the unemployment rate where it is, with the deficits rising. A more normalized interest rate here would be 3% Fed funds, not 2.25%. And a more normalized interest rate on the 10-year note might be 4% in the next few years, not where it is now. So again, be careful with everyone talking about lower interest rates. Be careful about people saying there is no inflation, never will be inflation. This time it's different. Technology has eliminated all inflation. Again, if everyone's saying one thing, okay, sometimes there's another viewpoint that's not being heard that should be heard. Okay. Now, again, if you have any questions, shoot me an email, optionprofessor@gmail.com. And if you have a different market or a different sector that I didn't cover in this rather short format, again, shoot me an email. I'm more than happy to help you out. All right. Until next week, I wish you all a very good weekend, of course, and a very good trading time. Again, we'll have to see if 27.75 and today's 28.25 can hold. And if it can, then maybe we can get a turn out of here. Watch your transports at the area of 10.5. Watch your Russell at 1500, 1550. Okay. And those are some of the things I'm keeping an eye on as well. That VIX gets above 25, bar the door, Katie, possibly, because you see in history, when it gets above 25, it can go into the abyss. All right. Be careful out there. Enjoy your weekend. Let's see what next week brings. I'll be back with you next week. And until then, have a good day and good trading.